So today we're going to talk about a different investment vehicle which are called bonds. So let's get right into it. Jason, tell us, what are bonds?
So bonds are a fixed income instrument, or said another way, it's an IOU. Okay, so where an investor basically lends money to a borrower in exchange for a stream of income. Okay, so a borrower could be like a government, a corporation, a municipality, and so let me just kind of break that up. So let's just say, for example, Apple. Okay, Apple wants to build a manufacturing plant, and it's going to cost them $1 billion to build that new campus or whatever. And so then an investor could let Apple borrow money. And they would basically be buying the bonds to be able to fund the building of that new Apple campus.
So that would be an Apple bond.
That would be an Apple bond from a corporation. That's right. So, and then Apple, let's say, says, well, I will pay you 5%, let's just say as an example, for that bond per year.
That's the interest rate.
That's the interest rate. And so if you give $10,000, they're going to pay you 5%, $500 per year. That's usually on a semi-annual basis that they pay that. And then they'll say, okay, we'll do that for 10 years. It'll be a 10-year bond. And the maturity, that would be the maturity, a 10-year maturity. Okay? So, and then you can, like I said, you can have different borrowers, like the government could borrow money, which they do a lot of. You can have municipalities that borrow money, like local governments, to build roads or hospitals or things like that too. And those are called muni bonds. So let's get into it a little deeper. So, and we talked about that. You have the interest rate that it pays. You also have the price of the bond, because a lot of people think of bonds as the interest rate. In that example I used with Apple, it pays a 5% interest rate. But the price of the bond also goes up and down.
After the bond has been initially sold,
exactly,
it becomes a secondary market instrument.
That's
not
right.
to get too technical, but basically meaning, if I owned the bond initially and I bought what's called par,
that's right,
which is the original value of the bond. So to be a little bit more specific, if Apple sold each bond for $1,000, okay, and I bought one bond, okay, so I'm going to get, in his example, 5%. I don't own Apple stock. That's different. I basically lent money to Apple, that $1,000, and for that they're going to give me $50 a year. Okay, so but now once I own this bond, okay, I can turn around and sell it, right?
Yep, on the secondary market, you can sell it, and that price of the bond can fluctuate. But different than stocks, it fluctuates a lot of times based off of interest rates.
Okay.
Not always. No, if it's a corporate bond, like the Apple example, if Apple does really bad, and there's fear that you won't be able to
get your money back.
Get your money back. It's going to potentially what they call a default, and they won't be able to pay the loan back. Then the price of the bond may go down. But in most cases, the price of the bond goes up and down. This is a good visual right here, based off of interest rates.
But inversely, right? Talk to us about what that means.
Exactly. So if, and let me kind of give you an example of how this works. All right. So let's say we'll use the same Apple example. You put $10,000, they're paying 5%. Okay. And then let's say the Federal Reserve, all right, which is one that determines interest rates a lot of times, let's say they start raising interest rates. I'm just giving you an extreme example to make the point, and they raise interest rates up to 10%.
The following year.
The following year, all right? So because those interest rates are now up at that high at 10%, when Apple needs to borrow to build a different manufacturing plant somewhere, they're going to now have to charge a higher interest rate, 10%, close to 10%. And so that investor, and when they're looking at either potentially buying those old Apple bonds that are in that secondary market versus getting a new Apple bond that's paying 10%, so the old one's paying 5, the new one's paying 10, they don't want that 5% one, they want the 10% one.
Right.
And so it causes those old bonds that are trading on the secondary market to go down in value, and then which would also cause the yield, based off of the price that you pay it, to go up on the older bonds.
So I like to look at it, if I'm the investor. So again, I just mentioned I lent Apple $1,000. Okay, for that $1,000, they promised to give me 50 years. That's the coupon, right? If you want the interest rate. Okay, so the following year, okay, as you said, interest rates went up to 10%.
Right.
Okay, so now Apple is issuing 10% bonds. Okay, well, I own this one that's 5%, but I want to sell it. Well, if you want to buy it from me, you're like, I'm not going to pay you $1,000 to get 50 bucks. I can pay $1,000 and get 100 bucks.
That's right.
So I said, okay, fine. I'll give it to you for 900.
Right.
Okay.
Exactly.
So that is causing my bond to go down in value, become discounted, if you will.
Right.
Now, if you do buy it from me for $900, it's making the interest rate more competitive.
That's right.
Because you're still getting the $50.
Right. But you're paying less for that $50, which makes the yield higher.
That's exactly right. So your effective interest rate, which is the yield, is $50 on $900 investment. Right. Okay, and that's what keeps it competitive. And the opposite is true. Let's say interest rates went down.
Right.
And Apple's now issuing bonds at 2%. You know, 2%. So I own a bond where they promise to give me 5%.
Right.
They can't change their minds.
That's right.
Okay? It's a contract. So you go to buy a bond and you're like, man, Apple's only going to give me 2. I say, well, I got one that gives me 5. I'll sell to you for $1,100.
That's right.
You know, so again, the interest rate went down, which caused the bond price to go up, that's what this picture shows.
That's exactly right. And sometimes people think about bonds in a traditional sense, where you always hold the bond to maturity. Because if you do that, and Apple keeps paying on the bond, it does go back up to its original par value. If it went down, or if it went up, it would go back down to its original value. So if you lent Apple $10,000, they'd give you back $10,000.
No matter what my price was at that point in the secondary market, the day it becomes due, the maturity date, Apple pay up.
Yeah, exactly.
You know, I don't care if on the market it's only worth $900. You owe me $1,000.
Right. But so a bond investor, though, a lot of times does not hold the bond until maturity.
Right.
They're trying to find a bond that they could buy at a good price and sell at a higher price.
Right.
Okay. So again, traditionally people think about bonds as only paying the interest, but the bond price can actually go up. It can also go down.
That's what people don't understand. Say, oh, I'm a conservative investor. I only invest in bonds.
Right.
Well, that's fine. Understand that conservative anything investing means there's risk.
Yep, that's right.
It might not be as much risk as a stock and not as volatile as stock, but bond prices can go up or down. So if I put $1,000, I just explained, next year it might only be worth $900.
Yep.
Okay,
exactly.
so
if you had to sell it that year.
If you had to sell it that year. So talk to me, I mean, you talked about Apple, but there's different types of bonds.
Yeah, absolutely. And this is a busy slide, but there are a lot of different types of bonds. You have the U.S. government bonds, which a lot of times those are called like treasury bonds, and then you also have another type of U.S. government bonds, which are like agency bonds. And sometimes have you ever heard the term Fannie Mae or Ginnie Mae, which is has to do with the mortgages and what backs mortgages. Those are pool of mortgages, and a bunch of them together, grouped together in one big bond offering that allows you to get the interest rates from the mortgages.
Right.
And a lot of times with mortgages, they pay, the people who have a mortgage pay the principal back along the way. So it allows you to also get the principal back along the way too.
Right.
You have mortgage-backed bonds or asset-backed bonds. You can have bonds backed by cars or different other assets that have value. They can be backed by that. Yep, ships.
Factories.
Right.
Yeah.
So, and then we went over the example of corporate bonds, went over the municipal bonds, to build bridges, hospitals, things like that. You can also have international bonds, not only for that particular country, but you can have international corporate bonds from the companies, and they may trade a little bit different. And there's different risk of each one of these. A lot of times, U.S. government bonds have been considered some of the safest agency bonds as well.
Right.
And then you get down to, inside corporate bonds, some companies who have, really bad credit ratings. So for example, imagine like if you were to use the example of a person, if they had a really low credit score, then the lender is not sure they're going to lend to that person, but if they do, they're going to lend at a very high interest rate because they're not sure if they're going to default on that loan.
Because you're high risk.
Yep. So you have what's called junk bonds or high yield bonds, which are companies that have a lower credit score, if you will, and so they but those are a little bit more risky, but also tend to pay a higher yield.
Right.
And then, sometimes emerging market bonds can be higher risk as well, depending on which country it's from. There's potential that the country can default on their loans.
Right.
So there's a whole bunch of different types of bonds.
And then there's also, I know we talk about investing being for the long term, but there's different types of durations as well. You talked about the maturities, right?
Right. So the time frame of the bond, which is also called the duration of the bond, you have different time frames. You have short term, which is like 5 years or less. You have intermediate term, which is like 5 to 15 years. And then you have long term that's longer than 15 years. And the shorter term they are, typically the safer they are, because there's not as much time for that company or that government to default on that loan. Also, they're not as interest rate sensitive. So there's examples that we were giving before. If it's shorter time frame to maturity, that doesn't have enough time for interest rates when they go up or down to really affect the price of that bond. But if it's a 30-year bond, you have a long time frame for that bond to mature. So it makes them a lot more interest rate sensitive. So the price of the bond can go up and down a lot throughout that duration of the maturity. Those 30 years.
Because of that, I mean, again, return is typically related to risk, right? So less risk, less return, typically. Longer risk, or more risk, more return.
That's right.
So usually long-term treasuries tend to offer a better interest rate than a treasury note, which might be 90 days or short, or short term. Is that right?
That's exactly right. Yeah, and it's important to know the different classifications of bond, the different types of duration of bond, because sometimes some do better than others. And sometimes a good bond manager, what they're trying to do is they're trying to adjust into different types of bonds depending on certain conditions. If interest rates are going up, maybe they want to go short-term bonds to try to protect against that inflation. The interest rate risk.
Because if interest rates are low and they're going to go up, that means the bond price, as we saw the chart, is going to behave the opposite. So that $1,000 I put in, as these starts going up, I'm going to start losing value. Okay. So, and again, the longer term bond will be more risk sensitive.
They would go down more.
It will go down more.
So, but if interest rates are going down, you want to get that appreciation, so you want to hold the long-term bonds in that time frame. So, and then just based off of kind of, you can even, there's different credit ratings out there. Like we said, you can have a like a AAA rated, which is a really strong credit rating. You can have junk bond status. So, in a good economy, the corporate bonds that are like a lower investment grade, since things are improving,
the high yield bonds.
The high yield bonds, since the economy is improving, it's less likely that they default on their loan. So that may be time to hold more corporate bonds and more high yield junk bonds, because they'll do better. But in a really bad economy, when the economy gets worse and the companies struggle to have profits, that's maybe not a good time to hold high yield bonds, and those can go down almost as much as stocks can go down.
That's right. So, and I talked about this in our lesson for stocks. This is very textbook, very academic, and not that we're trying to bore you, but we believe that you need to have a good understanding of what the individual instruments are, because especially when we talk about diversification and asset allocation, that lesson that's coming up, okay, we're going to show how they interplay with each other. And historically, stocks and bonds have been inversely related, so you use one to offset the the risk of the other. But we're going to get that to in the lesson. But this is bonds. There's a lot of dynamics. Not that you're going to become an expert, but we hope this helps, and we hope to see you soon.